All right, I'm gonna take the next segment and talk about a selection that I actually made last month, and I'm gonna make it again. The company is STRA Education. It's certainly no stranger to this audience. Ticker symbol STRA. I presented it last month as with a falling knife warning that you see there, and it has fallen significantly. Um, there's really not much of a change from the outlook that we had last month, although I'd be willing to take the growth rates down into the mid-teens, as you can see displayed here. Still qualifies as up, straight, and parallel. And one of the things I do want to make the point of is that again, the entire industry group really was getting pretty frothy. But also keep in mind, this is still just a 500 million, 600 million, $700 million company that is located in just a piece of the United States and seems to have a fairly strategic plan for continuing to grow as an educational firm, and anyhow, room for geographic expansion and a variety of other things. I just see a whole lot of positive indicators. I see up, straight, and parallel. One of the things that we have noticed is some people are getting a little bit dizzy from the roller coaster and they're jumping off, and I understand that. It goes right back to what Hugh has covered here for the last several minutes of confidence. But one of the points that I'd like to make to our audience is, a lot of times we sit around and we take a look at the history of companies, and we notice that the difference between their high and their low prices within any given year can be as much as 50%. And here's a case where we're just seeing history present itself again. Now, granted, it was too sudden. I mean, this company went from a stock price of 266 down to the mid-120s. So let's just basically call it a 50% price drop over a period of a couple of months. But I also just want to remind people that this is not unusual. I mean, take a look at any of the price bars year to year. Now, this one was far too sudden. That makes it way too scary, certainly probably fitting for a day like Halloween. But that range of prices from high to low is really not that unusual. Again, it happened too fast. I understand that. But how many times have you sat there and looked back at those low prices in the historical record for companies and said, gee, I wish I could have bought them? And there just have been so many times when I look back at those and I say, wow, I can't believe IBM was that low during 2006. Why wasn't I paying attention? Well, here we have an opportunity presented to us. We're a company that we know seems to be managed fairly well, and a little bit more in management here in a second, but here it is. It's in front of us. Again, the reminder in the shaded areas that those are 2 years of forward-looking estimates. That's our convention at Manifest, and the number out through 2015 actually looks pretty attractive. Well, speaking of management, here's our profitability analysis report card. I have a real hard time finding any trouble with that. Even with the 2010 year-end and 2011 profitability estimates, the outlook's actually pretty good for this company. And again, it's a testament to management. One of the other things that really strongly influenced me was a group of us sat in on the STRA Education conference call after their earnings report this week, so I got a chance to listen to Chairman Silberman talk about his company, and we're actually going to put together an educational session, and probably be a week or so out, where we're going to go back and listen to that in kind of a group listening session where we're going to translate what Mr. Silberman had to say about his company, and incorporate that or embed that within a stock study. So watch for that opportunity to come. But in a nutshell, I would have to say that he certainly displayed confidence. Some might even call it a little bit cocky, but a lot of confidence in this company and their long-term outlook. And it's almost as if I had a moment in the past where Michael Quinlan, when he was chairman and chief executive officer of McDonald's one day, he got an awesome question from the audience where they basically asked him about, what's going to happen when government intrudes, or, it had to do with some form of, nasty potential regulation for the restaurant business. And his answer was really pretty direct and pretty simple. He said, look, we've got a really good team here at McDonald's. We've got very capable individuals in all the areas of responsibility, and we're going to be okay. And then he went on to say, well, let me tell you where we're not going to be okay. If this were to happen, if the regulation unlevels the playing field, we could have challenges that are unusual challenges. We'd find a way to mitigate or traverse those challenges also. But so long as the playing field is relatively level, I have a lot of confidence in my team. And I kind of have that same message, reaching across through the airwaves coming from STRA Education. I think that as long as the rules are reasonable, they've certainly demonstrated a capability to compete in the marketplace of ideas. And they serve a slightly different clientele. They're immune to some of the really nasty rules that are going on. Again, we could be completely wrong, but again, I see an opportunity that's potentially deeply undervalued. Here's a quick look at the projected PE ratio so that we can apply these estimates to a equity analysis guide here in a second. It's a 10-year look back at the average price to earnings ratio and kind of a trend. And lo and behold, the company is maturing, becoming larger, and we certainly would expect the long-term trend of that PE ratio to head south a little bit, probably heading for the 15 to 20 range ultimately as it gets a little bit bigger. So that shouldn't be a surprise to us. I do think that those what could be construed as bubbles, the 2004 and 2008 bubbles there, they really did kind of jack up or hike up the price to earnings ratios and the expectations for many of these companies. And I really think that, much like what Hugh just went over, it's just simply some of the air coming out of that, industry-wide in this case, for the educational services industry. And what you're going to see probably over the next several months is kind of a plateauing or a settling in with expectations with respect to valuation across this industry. Here's a quick look at the equity analysis guide for STRA Education. On the left-hand side, you can see the current status. And oh, by the way, I was going to make an appeal to this crowd that I should get credit for making the selection a day ago, because, by the way, this company went from $126 to $139.96 yesterday. So, boy, I wish we could take credit for that. I made my purchase quite visible and quite plain on the manifest forum in the decisions manifest. So, but we'll take it at $139.96. I wish we could have had that $13 pop for the roundtable, but we'll take it as it is. Again, at that price of nearly $140, we're still only talking about a PE ratio around 15. And if we assume a forward growth rate of 14%, that's the number that you see here. If we assume a net margin in the neighborhood of that history, there are going to be margin pressures. Unquestionably, Silberman and his team certainly have challenges, but they have to try to maintain that, somewhere in that area, 15 to 20%. But let's just call it 20%. They've actually achieved more than that historically. If there is some expansion in shares outstanding, we could have a 5-year EPS estimate somewhere in the $15 to $16 range. And you'll see that I've used a PE ratio of 20. Our contemporaries at Morningstar or Value Line are still assuming numbers that are in the high 20s. Value Line was most recently at 29 for their average PE ratio. That may come down ultimately in their forecast, but even at 20, we're talking about a stock price of $300 5 years from now. By the way, they announced during that conference call that they're gonna raise the dividend by 33%, and they also are going to go forward with expansion of 8 new campuses. All of these things to me just seem to be signs of confidence, signs of strength, and I got to believe that Chairman Silberman does not believe that this recession is going to be without an end. And he certainly is putting together strategies with his team to take advantage of whatever happens with the end or whatever happens with the recession. With these assumptions, a 14% growth rate, 20% profitability, and a PE of 20, you still get a projected annual return of 19. To me, that seems pretty attractive when the current median projected annual return right now is on the order of 9%. So pretty good premium. And then just as a sanity checkpoint, the analyst consensus, this is from Finance Yahoo, they still project approximately $12 in earnings at the end of 2011. And by the way, I'm not going to do it today. We covered it last month. There has still been no deterioration or degradation of the long-term forecast from the analyst consensus for STRA Education in either the 30, 60, or 90-day outlook. Still hovering in that $12 range. That could change. If you're a shareholder or interested in STRA Education, I would certainly say watch that like a hawk. Watch the analyst consensus to make sure that you don't see any deterioration there, but still they're assuming an EPS growth rate long term of 17 to 18%, and all that says is that they believe that earnings 5 years out could be as high as 22.51. I'm pretty comfortable when we're in at 15 to 16 here. That's a full 31% less than the analyst consensus. Certainly a range. It's actually below the range where I would typically like to be, but it's suggesting that we could expect either a slightly higher profitability or slightly higher growth according to the analyst consensus, and certainly an area where we like to be. So my pick for this month is to repeat. This is our first repeat selection, and we certainly, one of the other points I wanted to make here, we're a few months in to the roundtable. It is okay to go back and double down or triple down on selections that we've already made, as long as you believe them to be among the best investment opportunities available, even when they're already in your portfolio, and we know that. That's just natural long-term investing behavior. So with that, we're going to make a transition to the next presenter, but I just wanted to take a moment just to acknowledge our friends over at Bivio. For those of you that are new into the world of investing or investment clubs, Bivio is one of the alternatives for accounting software for keeping track of your club records for your partnership tax reporting and everything. Superior, they do a lot of work with us on programs, and they support the efforts of a nation of investment education volunteers also. And again, just wanted to give a shout out to them and just say thanks. You can go to Bivio.com and check them out if you're not familiar with them. And if you're a Bivio customer, we just simply would like to join with Bivio and say thank you. So with that, I'm going to switch to Maria Ken Kavula, and he's going to present synaptics this morning.